Welcome to Market Movers. I'm Dave Hightower, joined by Dan Bosse. So Dan, a lot of roads converging here. We've got outside pressures, we got inside pressures, but now the USDA is going to come out. Are we going to change these yields? We're going to change demand? What's up?
Well, the USDA report will be out next Thursday, the 12th, and the report is widely expected to show a lower corn yield, David. In general, the biggest decline that we've ever had from an August to September yield was back in 1983 when we lost 15 bushels an acre in corn and 5 bushels an acre in soybeans. I don't think this will be that kind of decline, but we could see maybe a 5 bushel drop in corn and maybe a 3 bushel drop in soybeans.
And you look even further forward, the weekly crop progress reports, we're going to need good weather longer, but the 6 to 10 and 8 to 14 day show that good weather. What's that going to leave for the wrap up?
Well, I think we got to have a crop that comes home. This crop was late planted. Of course, we planted a lot of acres in June, over 30 million acres of corn and soybeans. Those crops need to make it to the finish line. The hard part from a supply perspective is understanding what a frost freeze may ultimately mean for final yield. So we could have an event that really cuts quality but may not have the biggest impact on yield. We'll see when that frost event occurs. Right now, most people are giving it an all clear up to about the 20th. That last 10 days of September and first 2 weeks in October are very important.
So on the demand side of the equation, we're also going to probably see some come out there also?
Well, I would imagine if the crop comes down in terms of size, we'll cut feed residual use in corn, likely a little bit on exports as this trade war continues with the United States and China. That's something we're expecting. How far is always the question. USDA takes a very methodical approach in cutting demand, especially this early in the crop year.
And maybe for some demand down the road, China's national average spot pig price up 104% this year to date, up 40% in August alone. So maybe down the road we'll get a little bit of increased corn and meal usage. So what we take away in demand, maybe we'll put back later. So before we dive into our trade discussions, I'd like to point out that these trades are examples and not recommendations or advice. So Dan, what's your idea?
Well, we like a bounce in the corn market. So we're looking at buying a December 380 corn call at 6 cents. I'm willing to risk 4 cents or a close below 2 cents with an upside objective of 14 to 18 cents. There's an open chart gap, David, somewhere around that 392 area for December. That's what we're going to target if the report is friendly as we look to the USDA.
And I'm looking at that also, looking at the market maybe being a little bit overdone. So as an example, I'm looking to sell December corn 360 put for 11 cents. I'm looking for an objective of 1 cent on the puts. Since we're receiving premium, I'm willing to risk 4 cents from entry. Another trade is somewhat out of the money right now, but I'm looking to capitalize on a large break right into the report. Selling a November soybean 820 put at 10 cents. Just ahead of the report. The market needs to fall, come down for that premium price to be achieved, but I believe there's some overvalue at 10 cents in that option, and I have an objective of 1 cent if the market consolidates or goes higher, and I want to look to risk 3.5 cents on the trade. So looking for that volatility to expand and contract after the report.
David, I like the trade. I think both of us are thinking the same way, that as we head into the report, there'll either be a bottom right before or right after, whether it's bullish or bearish, and then we get into the frost-free season thereafter.
Great. So Dan, on Market Movers, we like to educate new folks just tuning in. This time we want to talk about this financial maneuver we see in South America by grain producers, where they hold their physical commodity against inflation.
Well, they do. As we think about the South American farmer, the currency is the big determinant for them. In Argentina, the peso has been devaluating very acutely in the last several months. Right now, if we look forward to next July and August, that peso is at 105 versus 55 today. So South American farmers can see that. Lots of money on the table. They likely hold their beans, sell their grain.
And if they hold back, China has trouble finding those beans.
Exactly.
So thanks, Dan, for your insight. We'll keep a close eye on the market. Thanks for joining us on Market Movers. I'm Dave Hightower. Trade well and trade smart.